This webinar on VC and investor perspective is the second in a series of webinars that LebNet will be organizing to keep our stakeholders engaged, at least until we can resume our in-person events. I will not dwell on commenting about what extraordinary times we live in. We will, however, continue to shed light on how organizations and individuals are adapting and innovating during the pandemic and beyond. We're extremely pleased to bring today's session to you, and it's clear that there's tremendous interest in this topic, which is reflected by an unprecedented number of registrations, but this is mainly due to the great panel lineup we have here. And before I ask our guests to introduce themselves, I want to personally thank them one by one, especially that most of them are technically my bosses as they sit on LebNet's board of directors. So first, George Kadifa is managing partner at Sumeru Equity Partners and chairman of LebNet. Habib Haddad, managing partner at E14 Fund and LebNet board member. Habib Kairouz, managing partner at Rho Capital Partners and LebNet board member. George Akiki, early stage investor at Bolt, and believe it or not, I'm meeting him for the first time today and unfortunately cannot claim him as a family relation. And last but not least, Khaled Nasr, general partner and COO at InterWest Partners and a fellow co-founder of LebNet from 21 years ago. So I'm going to stop sharing, so no distraction here. And so let's start. We'll spend the next 50 minutes on questions I will pose to the panelists, and this will be followed, like I said before, with 15 minutes of Q&A from the audience. So please start submitting those online. Khaled, can you please briefly introduce yourself and describe what type of investments that your firm focuses on?
Sure. Hi, everyone. Again, Khaled Nasr. I'm GP and the Chief Operating Officer at InterWest Partners. InterWest Partners has traditionally been, we're a 40-year-old firm. For the first 35, we were a diversified technology investing firm and investing across the spectrum of IT, so semiconductors, hardware, and software, but also on the healthcare side, medical devices and biotechnology. 4 years ago, we made the decision to focus exclusively on healthcare, so biotech and medical devices. But the portfolio that we have, and we have about $2 billion under management and something close to 70 companies, is a combination of both IT and healthcare companies. My area of focus was IT, and specifically IT infrastructure, storage, networking, database technology, etc. I'm also involved with a few SaaS companies.
Great. Habib Kairouz, can you go next, please?
Sure. Hello, everyone. And a special hello and thank you for joining us for the people dialing in from Beirut at 1 a.m. I'm Habib Kairouz. I'm a managing partner at Rho Capital, where the firm was founded in 81, so almost 30 years ago. I joined in 93, almost 25 years ago. Initially, the firm was a family office managing the fortune of a European family, which we continue to do today. But when I joined the founder of the firm, we decided to open up the firm to outside capital, all focused on private equity investing in technology. We went on to raise 11 funds to date, a total of roughly $2.5 billion across our Rho Ventures and more recently our Rho Acceleration activities. Historically, we invested from seed to growth equity across software, digital media, communication, biotech, and clean tech. Today, we have two separate vehicles investing. Our early stage venture fund that's investing from seed to Series B, $1 to $7 million per company, specifically in software and digital media. And we'll talk about some of the sectors that we're focused on. We have a separate late stage fund that's called Rho Acceleration, that's investing as much as $100 million along with our LPs in recapitalizing companies in software and digital media. And those two sectors have been really the areas where I've focused for the last 25 years.
Great. Mr. George Kadifa, can you go?
Thank you, George, and great to see everyone. So I'm a co-founder and managing director of Sumeru Equity Partners. The firm was founded 5 years ago. We were a spin-off of Silver Lake. We used to be at Silver Lake, and then we spun out to focus on tech investing in the mid-market. We have 3 funds right now. We manage about $2 billion in assets, and we invest in companies that focus predominantly on scaling, typically companies in the $20 million to $100 million range in revenues. And we take these companies and we hope we take them to double or triple their revenue base, if not more, and eventually to exit either in the public markets or to strategic acquirers usually.
Great. Jeffrey, you want to go next, please?
Sure. Hey, everyone. Thanks again for taking the time. So my name is Jeffrey Ayer. I work on the investment team at Bolt. So Bolt is a pre-seed and seed venture capital firm. We back founders at the early stages, in many of the cases at the pre-product, pre-revenue stage. Right now, we're operating out of our 3rd fund, which is $80 million. And across all 3 funds, we've made around 80 investments. Half of them are in B2B companies, half of them are in B2C companies. And we tend to lead the rounds in most of the cases, but we're also happy to collaborate with other investors. And the check size ranges between 200K up to 1.5 million, depending on the stage of the startup, etc. And so we tend to work very closely with portfolio companies to really help them during the early days, to help them build strong foundations for their businesses. So this includes things such as working on their go-to-market strategies, business model, as well as helping them build their product teams. Thanks.
Great. Last but not least, Habib Haddad, please.
Hi, everyone. So I'm the other Habib, the less handsome Habib. So I actually have a quirky route into the venture investing. I moved to the US about 18 years ago, then started like many other partners and firms as an operator first. But then after I sold my last company, I found myself in the middle of the Arab Spring Revolution, not by design, but by pure coincidence. Most of my friends have been moving things on the streets and being activists. And then I got quite excited about what was happening, but disappointed with the outcome. This is kind of where one of the sparks of that pushed me to move back to the region in 2012 and co-found WAMDA, which ultimately became a platform for early stage founders, but ultimately also as a venture fund. Since though 3 years ago, I moved back to the US and I co-founded E14 Fund, which is a fund that has an official affiliation with MIT. So we're the only fund that has this kind of relationship where we invest in deep tech companies and companies based on deep science. So we invest in the very early stages in companies ranging from robotics to things in food tech and ag tech and life sciences. And we're early stage, so the fund size, we were today at Fund 1, $40 million, this fund size, and we write checks between $500,000 to $1 million.
Great. So thank you all. Moving to the next question before I do, there was an article in TechCrunch on April 13th about a discussion with Marty Pitchinson from Sherwood Partners, which is a restructuring firm that Bay Area VCs frequently turn to when they need help liquidating assets of startups they funded. 3 years ago, when the startup world was humming along, Marty's firm was winding down 2 to 4 companies per week. Now it is winding down 2 to 3 companies every day. The startup world is certainly getting its share of disruption. So let's try to understand some of the aspects and nuances of the pandemic impact. Habib Haddad, I'm going to start with you. From your vantage point and subsequent to discussions with your counterparts in other VCs, and by monitoring what's going on out there, can you describe how portfolios are affected in general by COVID-19? Roughly, what is the percentage of the portfolio of startups at risk? Percentage of those merely with delayed plans, maybe a percentage of the businesses or the ones that are business as usual. And hopefully, if there is any, the percentage of those who are seeing new growth opportunity. You want to start, Habib?
Yeah, for sure. Obviously, the impact on the early stage is going to be felt later than the impact that you're seeing that you mentioned on the growth stage or established companies. Usually, that comes a bit delayed. But if I were to categorize the impacts and the effects that companies are seeing, I think they would put them onto 3 buckets. There's the human level, there's business operation, and then on a strategy level. So on a human level, that's where people are getting pushed to working from home. CEOs and especially first-time CEOs are finding themselves in a completely new situation, figuring out how to build culture, how to figure out of onboarding hires that they might have promised an agreement to. And so, and especially some of the companies that we invest in that tend to be in deep tech and hardware are figuring out how they will go around and actually getting the people to work on the hardware or work in the lab. So that's obviously on the human level, the first impact. And in this case, everyone is impacted. The second impact that people are also facing is on the business operation. And obviously some companies have a bigger risk than others, especially those in B2C. We don't deal with B2C companies, but from hearing and I'm talking to others, B2C companies, especially if those are the exposure to ad space, are definitely getting impacted very quickly. Those even in the SaaS world are seeing some churn. Some companies who have year-long partnerships and agreements will start seeing that impact also coming to them a bit later in the year. But some industries that are resilient to that are those in food tech, in health tech, and also in supply chain, especially some areas in supply chain. And this is where on the business operations side, you see founders really figuring out, struggling and running around, figure out how to extend runway. The third aspect is on strategy, and founders here are finding themselves in a unique situation. Some of these founders are finding new opportunities, so they're doing really big pivots. And I'll mention a couple of examples in a bit. And then others are finding themselves even doing small adjustments. So rather than you becoming a company that's selling an innovation, you're trying to adjust yourself to becoming a company and a startup that's helping companies with cost cutting or cost savings. Executives in an up cycle are paid to innovate. At this point, they're paid to figure out how to cost and cut down costs. And I'll mention I mentioned two very quick examples of companies who actually are seeing growth and opportunities in this space. So one of our companies has built a 3D printer that is inspired by the printing press. It prints roll to roll, but more importantly, it can do these very fine structure, hair-like or feather-like structures. Really amazing, high-resolution, high-speed printer that no one else had built in the world. And when they, right after the pandemic, they got a call from Beth Israel. Funnily enough, not nudged by me, but by another LebNet member, Rami Arnaout, who's actually the head of the microbiology at Beth Israel, who reached out to them and said, "This is quite interesting. You could actually repurpose what you've done for swabs. We know that there's a huge shortage of swabs today in the US. So in just literally 48 hours, they were able to repurpose their printers, print it, got FDA clearance, and now are actually shipping through some of the largest distributors in the country to states and to hospitals. So that's company number one who saw an interesting uptake there. Company number two is a company that had built radar technology and sensing technology to see inside boxes. And some of their customers today are these customers that everyone is ordering things from, because they do quality check inside of the boxes as these boxes are moving down the conveyor belt or as they're moving around the warehouse. So obviously, with the pressure that's being put today on delivery and the consumer behavior change and asking for things to get delivered at home, you're seeing a huge pressure point right now on the supply chain and on quality check. So that's another company that's now figuring out how to take advantage of this opportunity right now and be able to sell more there. But I would say on a high level, every company is getting affected. Some people are trying to be creative around it, but in the near term, it's gonna get tough. On the long term, some companies are able to survive, might actually see a strong return to them.
Great. Jeffrey, you want to take a shot at this question too, please?
Sure.
How you're seeing portfolios being affected?
Yeah, for sure. So for the vast majority of the early stage startups, it's pretty rough times. A lot of them had to delay their launch dates. A lot of their customers put their pilot projects on hold. So it's pretty rough, especially for companies that operate in sectors such as retail, travel, and the ones that offer consumer nice-to-have products don't tend to fare well in recessions. However, we have seen some sectors that are flourishing at the moment, such as health tech, future of work, and some companies were able to find sort of the silver lining to make their businesses even more valuable than prior to like the pandemic. For example, one of our portfolio companies offers a portable medical device that helps monitor lung function for children with asthma or cystic fibrosis. And they've been seeing a huge spike in demand given the fact that a lot of the vulnerable patients are finding it super valuable to be on top of their health and make sure that they're doing well. In addition, there's another company called VergeSense, which offers office use, like office utilization analytics using computer vision. And right now they've been seeing also a big spike in demand, especially because they can also monitor social distancing. So it's definitely the majority are finding it super hard, but there are some sectors that will flourish.
Great, thanks. Habib Kairouz, do you want to take a shot at what you're seeing from your end?
So for many of us who are showing our gray hair, we've been around, this is probably the third major downturn that we've witnessed in our careers. The first one being the internet crash in 2000, the second being the credit crash of 2008, and now we're dealing with the third one. At least for us, this hasn't been as bad as the first two, but could end up being as bad as the first two. And the reason I'm saying that is that as opposed to in 2000, we saw a crash that fundamentally challenged the business models of a lot of the companies that we were investing in. In 2008, we saw capital literally dry up for any types of companies, good or bad business models. Today, the bulk of the conversations, at least that we've seen in our portfolio, first of all, we've seen management teams react much faster to the downturn than we certainly saw in 99 or in 2008. In other words, almost every single company in my portfolio had a board call within a week of this happening, of the lockdowns happening, and had already started developing plans to react to the lockdown and the virus issue, as well as a second contingent plan that will react to the macroeconomic downturn that will result from the virus. I would say today we're looking at the crisis in two stages. We're looking at the short-term crisis from the virus, and there we have 1A and 1B. 1A is a U-shaped recovery, 1B is an L-shaped recovery. In other words, does the world go back to normal in July and sometime this summer, or do we hit a second wave and vaccines are late to come to market? And then the second issue that we're certainly scrutinizing very seriously is the macroeconomic damage that's been created. In terms of looking at the portfolio today, I would agree some companies have really taken it on the chin, specifically those operating or selling into sectors like retail, travel, or hospitality. We've seen literally things like we've never seen before, where revenues go to zero overnight on very good high growth companies. Those that have experienced that kind of a downturn, as long as they're funded or have investors that have enough resources, should be okay because they've managed their cost structure very quickly. As the world opens up again, they should see the bulk of their current revenues come back. We've seen some companies actually, companies benefit from this. We have a company in the webinar space that had literally 300% outperformance in new bookings last quarter. We're seeing companies in the consumer gaming space, in the security space, in online home entertainment, like over-the-top consumption, actually benefit from this crisis. The bulk of the portfolio, especially in the B2B space, where we have subscription recurring revenues, are seeing relative stability for now on their recurring revenues, their current base of revenues, meaning no panic and cancellations from business customers. And again, that could change if the macroeconomic downturn is much more severe, but relative to the lockdown and the virus, that revenue base seems to be okay. New bookings, on the other hand, have come to a complete halt because everybody's home and no one's worried about buying a new or subscribing to a new piece of software for the time being.
Great. Thank you, Habib. I'm going to go back to Habib Haddad with another question. What are you doing differently, Habib Haddad, these days to mitigate and address COVID impact? Are you doing more reviews, more board meetings? Just tell us about sort of how has things changed at the sort of at the VC level. What are they doing different these days?
Yeah, I think the first thing, as Habib Kairouz also alluded to, is that we did board calls with every single one of our portfolio companies. And some of the things that we really focused on is, do you have enough runway? Do you have enough runway? Do you have a 12 to 24 month runway that will allow you to survive and emerge from this? And so that has been number one, being on top of that, and also making sure that we are very close to the founders as they figure out how to manage this new period and think about putting in safety measures for the employees, especially those who are still active in the hardware space. So that's number one. Second thing is with our own LPs, making sure we're over communicating with our own LPs. People are seeing their stock holding go down like crazy and are worried about it. We actually even did a capital call in the middle of this. I mean, we had to just also beef up and be ready, because obviously one of the things is we're lucky that we have a very strong reserve strategy for each $1 we invest, we keep $2 in reserve for companies. So we actually have been working a lot on that, making sure that we can use some of these reserve strategies when needed for companies. And also we've been helping founders think about priorities. Obviously in this time, people have so much on their plate, and helping them simplify priorities and think about the things that they really just need to worry about in the near term, and then emerge from that. And we've been also taking business development roles as well with many of our companies, especially those who are seeing new opportunities today that haven't seen before. So I would say, in general, we're taking a much more operational approach with our companies, just trying to fill in gaps where we can. And then second is trying to be on top of things and seeing the trends long term, so that we can help companies see that. A great founder is someone who can see the future, but also be able to execute flawlessly. And I think in this time, we're just trying to be another add-on, if you want, to the founders to help them with that.
Great. Jeffrey, I know some of the stuff that Habib Haddad mentioned is probably common to what you're doing. Anything you want to add about how you're doing things differently?
Yeah, so definitely we're doing a lot of deep dives with portfolio companies to find creative ways to extend their cash runway. So we're helping them rework their operating plans, etc. But in addition to that, we're holding weekly portfolio review meetings with the Bolt team to make sure that we can bring our collective expertise and make sure that we're on top of all the needs of the different portfolio companies, especially because we're managing like a big portfolio and we have a small team. So it's it definitely helped us make sure that depending on the specific problem or specific need that the portfolio company, we plug someone from the team and make sure that we sort of parachute and help them out with their needs.
Great. Abdo, I'm going to move to you for the next question. In your opinion, and post-COVID, which industries and technologies will A, grow faster, and B, which will be negatively affected, and C, anything in between? Any thoughts on that?
Yeah, George. First and foremost, we're very bullish on technology in general. What we're seeing now with COVID is the physical world has become insecure. And my personal belief is this is going to take 2 to 3 years to settle, unfortunately. That is, even with vaccines and everything else, this is not going to be a short-term solution. However, the information world is very robust. Here we are, we're 70, 80 people talking from all over the world. So what's going to happen is an acceleration from the physical world to the information world, and it's happening in front of our eyes. And this crisis has been actually a great motivator and a great agent of change to push people to that last level of living in the information world. So in general, we're very actually positive on technologies in general, especially information technologies. Clearly within information technologies, different businesses cater or service different markets. And some of these markets are impacted. That is, if you have today software that services the hotel industry, yeah, you're not in good shape. You have to change your customers. Or if you have a company that does work in supply chain, you have to readapt because supply chains are being readapted in this regard. But in general, we're very bullish on technology. If outside technology and within technology, anything related to collaboration, communication, all those pieces are booming. We have, or in also in everything that is what we're calling tele, like teleschooling, telework, tele whatever, is going to do very, very well. And I'm very bullish on it. The industries that are clearly going to be impacted are industries that rely on the physical component in their delivery. Anywhere from all resource industries. That is, what we've seen in the oil sector is just an indication, but this is anything related to natural resources beyond oil, in copper, in raw materials, everything in that regard. Is not going to remain attractive industries. I just read a statistic recently that the price of oil today on an inflation adjusted basis is exactly the same price of oil in 120 years ago, in the 1800s, late 1800s. Natural resources industries are going to be impacted. Clearly, hospitality, transportation, and any industry that requires more and more physical contact, are going to be impacted in this regard. But on the technology front, I think everyone should double down. It's been actually, and if you look today, the NASDAQ is backed almost to the levels that it was before COVID. And that's an indication of what's happening.
Great. Khaled, do you want to take a shot at the same question? Basically,
sure.
What industries you think are being affected negatively or positively?
Yes, and I think it's important. I mean, obviously, we all have theories here and thoughts, but sort of the underpinnings are important. And Abdul described his. Tell you how we're thinking about it. Basically, the question was post-COVID, and I agree with Abdul. It's not like a switch is going to be turned on and we're post-COVID. I think we have to think of this situation, different levels of intensity, lasting 2 to 3 years. So what my answer is going to be built around sort of the next 18 months to 36 months. And assuming that there will be treatments and vaccines coming in 12 to 18 months, but despite those, there will be additional new localized outbreaks, recurrences of stay-at-home for the foreseeable future. So it's not going back to a complete normal, but sort of a new normal incorporating the effects of COVID. And the other thing I'd like to say is I think because of what's going on right now and what will continue to go on, sort of the thinking is framed by some big trends that are happening now that we'll call them new habits that are forming and will not go away. Some of those are what Abdul mentioned. Digitization and move to the cloud will accelerate. We're already there. It was already happening, but now it will accelerate. I think people will be spending more time, not just working, but obviously eating, exercising, and being entertained at home. This concept or this factor, which has started right now, will not be as severe, but it will continue to be the case that people are doing more at home. Because again, for the foreseeable future, we're going to be reacting to some remnants of COVID and the after effects of COVID in the population. And last but not least, I think a big trend or is automation, robotics, and AI, which were already sort of on a big wave, are going to be increasing because generally they have a lot of benefits, but one of them is more efficiency, and machinery and automation, unfortunately, has fewer complications than humans. Machines are less messy than humans. So I think this move towards robotics and automation, which has been here for a while, again, will accelerate. So digitization, more time at home, and those. Based on that, what we see as industries that are going to be benefiting from this, again, I was worried we'll be all repeating each other, but I'll do a little bit of that. Anything to do with remote working, collaboration, file sharing, and remote education will be on the upswing. Bandwidth, connectivity, and security, cybersecurity on the upswing. Home entertainment, video streaming, gaming companies, podcasting companies, video creation, broadcasting, and streaming companies, all of those are going to benefit. Home fitness and health as well. Home office technologies and services. Again, I anticipate that for the foreseeable future, people will be working a hybrid mode, partially in the office, but partially at home, more so than ever before. And so you have to have the right infrastructure at home so that you can do that similar to what you would have at the office. And finally, the online or the online food delivery, product delivery, and restaurant deliveries, that's boomed right now. It'll continue to be an interesting area and will benefit from this. On the downside, I think what's going to be affected big time is the sharing economy. And there will be many attempts to try and reform the sharing economy to take into consideration COVID. But I think generally this is going to be a tough space and tough area when people are nervous about who else was in the car or whose house they're going to go live in, etc. So the sharing economy, I think, will come out weakened by this. Anything that's facilities-based, whether it's retail, restaurants, health clubs, gyms, is going to suffer from this. The obvious ones, travel and lodging and so on. Two others that I'd like to mention, if I have 2 more seconds. One is commercial real estate. I think one of the big effects of this is going to be a significant reduction in the need for classic commercial office space. And we're already seeing this. I happen to be in the middle of it right now. So we're seeing this already, and I think it's only going to get worse. So commercial real estate and all of the adjacent businesses that serve commercial real estate, lunch places in cities, office cleaning, etc., are going to be hurt. And last, I think many green initiatives, which tend to flourish when economies are doing well, are going to now be hit again, where they'll have to justify themselves and are going to find it hard to justify these green technologies from an ROI basis. If they can, no problem at all. But if they can't, I think they're going to be pushed back to the back burner by large companies, by governments, by different authorities. So that's what we see happening at a broad level.
This is awesome. I want to ask Habib Kairouz lastly to take a shot again at this question if there's anything to add on what Abdo and Khaled said.
So I want to take a different approach to answering the question, not because I disagree with Abdo or Khaled, because I do largely, but I look at it slightly differently. I don't disagree with the fact that we're dealing with a crisis that could go on for 1 year, 2 years, or even 3 years. But at the end of the day, we're investors for the long run. We invest in 10-year funds, out of 10-year funds. And certainly for our VC activities, I'm looking at waves that are fundamentally disrupting industries or creating innovation over the very long run. Do I believe that COVID has fundamentally changed how I look at investment opportunities for the next 10 years, or how I looked at those investment opportunities 3 months ago? The answer is no. 3 months ago, I was looking at AI, machine learning companies, robotics companies, blockchain technology companies, fintech companies, focusing on security and mobile security, and I'm still looking at all of those sectors. Sharing economy is certainly a sector that is being hit very hard today and will continue to be hit as long as the specter of COVID hasn't been fully resolved. Do I believe the sharing economy is gone over the long run? I don't. I think these business models are here to stay as long as the companies operating in those business models can figure out how to readdress their cost structure and their operations over the next 3 years or 4 years or 2 years, however long it takes. I think some sectors are here, some new investment opportunities have been discovered by this wave. Specifically, working from home has always been a kind of a tangent opportunity for an organization because no one really knew whether it really worked. Today, I think the jury's back in that you can actually work from home and work productively. Conferences, there's always been this physical aspect of it. Webinars were a complement to the core physical conference business. And again, we've just proven in distance learning, that there's a real opportunity that's here to stay. So I think these are incremental opportunities. Will they nip at the heels of the size of the markets that they're displacing? For sure. But those were not opportunities. I mean, those were not markets that we were necessarily looking to disrupt out of our venture capital activities. Retailing will continue to be hit, maybe at an accelerated pace, traditional retailing with e-commerce. But again, as VCs, we were not investing in retailing. We were investing in e-commerce in the first place. So to cut a long story short, when I look at the Gartner cycle of hype and the next waves of innovation for the next decade or 2 decades, I see the same opportunities that I saw 6 months ago. When I look at the short-term investment opportunities, maybe in the public markets and technology markets, there certainly will be dislocations for the next 2 to 3 years until this crisis is resolved. And if there are tangential opportunities to address some of the new emerged opportunities from work from home, like security on these types of devices, will certainly be new, very specific kind of waves, but not fundamentally disruptive wave, in my opinion.
This is thank you, Habib. This is very interesting. As a matter of fact, I was just thinking I'm going to go back to the recording later and take notes and try to see if to invest in some new or not to invest in new companies.
Actually, I was worried about the recording that 4 years from now, I'm going to be listening to this. and we're all going to remind each other for what you said.
Yes, exactly. Let me move to the next question. It's sort of related, but it's not. Khaled, do you agree with those who claim that the world post-COVID will be different than the pre-COVID world or the current COVID world? If so, or let's just say pre-COVID world, forget the in COVID, but if so, how will doing business be different in the future, you think? You know, once a vaccine is out and we're sort of back in, will there be differences?
So again, I mean, I think there's a lot of things we can talk about. I'll focus on 2 or 3 maybe. I think first, this is maybe not different, but the cost of doing business is going to go up. The response typically to these crises, whether it's 9/11 or the 2001 crash, 2008, things like Sarbanes-Oxley, government comes in with increased regulations, controls, guidelines, and so on, which add to the cost of doing business. And that's already begun to happen, and I think it's only going to get worse. I mean, if you have to test every employee every day, again, I'm talking again within that window, not 10 years and 20 years from now, that next 3-year window or whatever. If you have to test every employee, if they have the right to work from home, if anybody who is mildly not feeling well can go home and take the day, whatever, the costs are going to go up. So you have specific costs from compliance, monitoring, testing, etc., that are going to go up. Social separation in offices, if you stay in offices where you can fit less people in offices, those are going to go up. In different businesses like factories, warehouses, and restaurants, again, so already they're experiencing that, but social separation will increase their cost of doing business. And enabling this hybrid work at home and that the office model, which I think, again, is here to stay, could add additional costs to the way of doing business. So in general, again, this reaction, especially the governmental reaction to a crisis like this, tends to impose some additional controls, regulations, etc., on businesses, on society, that translates into higher costs. So that's one thing. I think another one is the trend towards, which we've seen for a while, although that, you know, you could argue was already happening, but the trend has been to concentrate talent wealth, especially in the tech sector, in certain hubs. The feeling was, in general, being together and being proximate to your coworkers and so on was critical, and that's where the magic sauce happens, so to speak. I think as part, again, of this movement out of offices into homes and so on, where you are is going to matter a lot less. So that actually will allow, either you can look at it 2 ways. People who are in the hubs may be less desirable than they were before, and people who are not in the hubs may become more desirable, more able to access jobs, more able to participate in this knowledge economy than previously. I'll stop there. I have a couple of others, but I'll stop there. I know others are going to answer it.
No, this is awesome. The other person I was asked the same question to is Habib Kairouz, actually, if you want to take a shot at this question, which is how will we be doing business differently after COVID or post-COVID?
I'm not going to repeat everything Khaled said because I agree with him. But again, I would draw the line between the medium term and the long term. In the long term, do I think that people are going to go back to restaurants and sit at as many tables as the restaurant can fit? The answer is yes. Do I think they'll go back to sports arenas? The answer is yes. And do I think they'll work out of offices? The answer is yes, but they will be much more accommodating of people working from home. In the medium term, I agree with everything that Khaled said without being repetitive.
Great. Good perspectives. Jeffrey, I'm going to ask you the next question for you to start with. What advice do you have for CEOs of startups and SMEs today? How should they handle the situation? How should they, if they're looking for funding and all of that, what would you recommend to them?
Yeah, so we expect the fundraise environment to take a hit, and it might take 18 months for it to recover. So the challenge for a founder is, even if they made great customer progress, they have great validation, if there's still a pinch on the funding environment, it won't really matter. So you need to survive long enough to be in a position of strength once everything goes back to normal. So for a pre-seed and seed stage startup, the most important piece of advice is to extend your cash runway. So that can be achieved by making cuts earlier and harder than you might think is necessary, because at the end of the day, the earlier you cut, the more runway you save. Try to get to cash flow break even. Super hard for a lot of early stage startups, but it can be achieved in some cases. We're seeing a team of 2 founders and an MVP actually pull it off at the moment. In addition, if it's possible, bring cash on the balance sheet from your existing investor as well as new investors. So it's every week it's going to get tougher and tougher. So if you have an offer on the table, take it. It's not the time to be super picky about the terms. And finally, try to see if there's an interesting angle where you can provide value to companies or to people going through these challenges. For example, we have a portfolio company that is that connect job seekers to employers through videos. So they're targeting the Gen Z demographic. So right now they're actually working with Amazon, CVS, and Instacart to help them hire really fast. And they were able to connect with them because of what's happening right now, and they're scaling really fast right now. So these are mostly what I think is necessary for founders to keep in mind.
Great. Habib had that same question. Any advice to CEOs of startups and SMEs?
Yeah, I mean, I think three big high-level points. The first one is don't expect things to change soon. And what this means for an entrepreneur is entrepreneurs are usually natural optimists. So they are waiting there every single piece of new news. They expect things to change quickly, and they get excited about a vaccine or a drug, and then they think that things are going to come back to normal. But what that means is that, as Jeffrey said, making sure you have enough runway, extend your runway, be decided about cutting costs where you can, and also double down on existing relationships. So meaning VCs that you have met physically in the past, or customers that you've met in the past. These are relationships that are probably the lowest hanging fruit right now to try and move forward. And this is one area to focus on. The second thing is cut and simplify. Besides focusing on survival and extending runway, this is also the time about simplifying the decision-making process within the company. So think about, if you haven't done a decision matrix before in the company, think about implementing that. Think about implementing some procedure that allow you to really simplify the process by which you actually are going to start thinking about the different angles. And the last one is seeking opportunities. And so obviously we've heard a number of examples of how companies are seeing opportunities. But if you think also about the trends, for example, if you're in the healthcare space, health professionals today aren't taking patients. And so what does it mean? It means that people who have clinics might have more time and might be willing at thinking about analytics or analyzing how their clinics have performed. So rather than actually service them in a way to optimize performance, maybe it's about analytics. But also it means that people are pushing down elective surgeries. It means that they're also open claims. It means that the insurers are probably still in business of figuring out also how to get ready when things come back online. It also means that in other examples is we have a company who's in the AR space for cross-team collaboration, and they saw a 5x increase in sales just a couple of weeks after COVID. And this company had to move faster in launching a product, even not as fully baked, a public product, earlier than anticipated, because they want to take advantage of the current situation. Other companies, other types of examples are one company of ours that does mitochondrial genome engineering, and some of their technology could also be used to sequence RNA in a very effective, fast manner for rapid testing of COVID. And so they kind of came to the board and said, listen, we have this opportunity. It's not directly within our line of business, but we think we can actually do that and potentially even unlock opportunities for down the line, other kind of virus detection. So as a founder, you want to be assured that you seek opportunities. But as you do that, make sure that you're aware of predatory behavior, especially from potential investors around waiting until they come in and then they start putting terms that are a bit too stringent. You do, as I agree with Jeffrey, you do expect things to. You don't want to make sure you're not being very picky, but at the same time, make sure that you're also not basically marrying yourself to terms that are going to be very hard to back away from down the line.
Great. Thanks. Abdo, you want to take a shot at this question too? Any advice to CEOs?
I work directly with 5 CEOs right now in our portfolio companies, and I sit on their boards. And it's been quite consistent. That is the first thing we ask them to do is to be convinced that their value proposition is still valid. What you're offering today, does it work or not? Is it being challenged? Or actually, if there is an opportunity, what the opportunity is? And to give you some statistics, out of the 5, 2 actually is value proposition is going to improve because of COVID, and 2 are going to actually have some challenges, and 1 is neutral, just to give you those perspective. So the value proposition is very critical to make sure that what you're offering in terms of products and services actually work. The second piece is your operating model. Are you in a situation where are you consuming a lot of cash or not? How efficient are you? Do you need cash more to actually grow more or not? And what we've done is for each one of these companies, we ask the CEOs to develop scenarios. A scenario that is very pessimistic and a scenario that is very optimistic and somewhere in between. And that actually brings into light what these companies will need. The third piece we said was freeze your cost today. Just do not spend anything because we don't know what we're heading into. And frankly, we didn't ask for cost reductions at this stage because based on these scenarios, so far so good. But we have instituted expense freezes to ensure that these companies remain healthy and they're not investing into areas where we don't believe that they're going to get the return from it. The fourth piece is, and actually I should have mentioned that as the first one, which is take care of your employees first and foremost, and make sure. We had one situation, a company that had an office in the UK. Unfortunately, one of the employees died from COVID, and we had to go and take care of the family and make sure that that's being supported. So the employees are going to be king here and queens. We need to take care of them. We need to make sure the work from home. We developed a whole protocol on how to manage IT, how to manage security, how to manage employee benefits, how to manage employee health, and on. And that's going to be and that's going to be critical in what we do going forward. These are our current experiences. Also, in terms of CEOs who come to get funding from us, today I just signed an agreement to acquire a company, to give you an example, because we believe that company is actually growing in the current situation. It's in a technology sector that is going to do extremely well in COVID and post-COVID. And in some ways, we're going to learn a lot from it. I can assure you, do not go to a management consultant or to financial analyst or to pundits. They have no idea because we never had something like this before. We're going to develop all these metrics and these businesses and these turnaround times intrinsically, and it's going to be an interesting journey.
Great, thank you, Abdul. Habib Kairouz, you want to take a shot at this one too? Advice to CEOs?
Sure. I guess our playbook here has been first and foremost safety to all the employees and everybody around. Second is ensure that you have 24 months of cash runway from a liquidity standpoint through combination of cash infusion, debt refinancings, cost cuts, cost deferrals, whatever. But our experience from the last two downturns is that irrespective of a company's value proposition and market opportunity, investors tend to operate in a herd in any market, or most investors tend to operate in a herd. And when there's blood on the street and there's panic, people freeze. Even if they have funds, typically people just want to wait to see better clarity. And companies could end up being the victims and the casualties of that behavior. And priority number one should be to ensure to have at least 24 months of liquidity. We're also dealing with a scenario. Most of us know how to deal with an economic downturn. No one can forecast how long they last, but most of us know how to operate in an economic downturn. The real unknown here is this COVID and lockdown scenario, which none of us have experienced before. So given the fact that there's an element of unknown, it gives an element of uncertainty, and therefore we're encouraging CEOs to have real-time KPIs and metrics that they're operating with internally that allow them to have rolling forecasts and dynamic adjustments to their assumptions, because their assumptions could very well be wrong, given that we have no other scenario to benchmark against. And finally, once all of these things are in place, we did encourage a handful of companies in the portfolio to actually go on the offense in this environment, given that we saw opportunities for them to invest and capitalize from a competitive standpoint on a window of opportunity where they could grow much faster than they would have otherwise, without getting into specifics. But we all know that some of the best companies out there today were created in economic downturns, with less competition and less heated environments in terms of marketing cost and go-to-market efficiency, so on and so forth. So I would put that in the fourth bucket of priorities, but it's certainly an opportunity for companies to take advantage of.
Great, thank you. We're running about 5 minutes late, and I really want to stay on time so we can start with the Q&A. I'm probably going to skip one question. I'm going to move to my last question and start with Abdo. Abdo, what metrics are you specifically tracking to indicate to your firm the start of a recovery? Are there metrics that you guys have, or just
yeah, definitely. There are actually, there are metrics on a macro level, and there are metrics actually we track through our own companies. And we're lucky that our companies in our portfolio track a lot of the economy in general. So at the macro level, there are really two metrics that count. The first one is the infection rate. Is the infection rate increasing or decreasing, and where and in which geographies? Because some of our companies operate outside the United States also. And the second metric is unemployment, because that determines literally the way the economy is going. And so far, both metrics have been negative. The infection rate keeps increasing, and unemployment, that is, we have right now more than 20% of the productive US population unemployed. And that's massive. And that's why I believe that the world post-COVID, on the long term, the next 10 years, and that's where I might disagree with Habib, will be very different from what we're seeing post-COVID. There are some fundamental changes in the way things are happening. So these are the two main elements that we track. We don't track GDP growth. We don't track levels of money supplies or debt or things of this sort, or even interest rates. That is, interest rates at this stage are so irrelevant. On a more micro level, some of our companies, one company is in the supply chain framework. So we're able to actually track the level of shipments, be it parcel or be it in containers across the world. And that gives us an indication on the activities that are happening. And we know that that level is low now, but we're able to track it on a weekly basis, and we have a lot of data in that regard. The second one is we're tracking employments and testing of how deep is the unemployment is happening, and when we're going to start seeing employment pick up again. Clearly, we're in a downward spiral right now, but we have the capabilities right now to detect in a very statistically relevant way when the unemployment is will start to improve. The third piece we track is actually number of classroom sessions. We know exactly today in the school system on K to 12 the number of classes that are being conducted, and that's a very important element for us because it's more on the educational level, and that helps us significantly. So that's another metric we track. And there are other metrics also. There are a couple of them I really can't mention here, but in general, we're very well equipped to understand and to predict a little bit when we will see some recovery.
So you're not tracking the Lebanese pound currency level? Just kidding. Khaled, do you want to take a shot at this question too about the metrics on that you're monitoring for recovery? Khaled, you're on mute. Sorry.
Sorry about that. I knew it would happen at least once. Now it's twice. Okay. Yes, I won't repeat everything that was said. So just very specifically, one of the things we've noticed within companies now, so this is not the macro picture, but the specific micro picture, when we're looking at our companies and what we're asking them now to report regularly is the manner in which customers are paying their bills. Okay, so you could think of it as DSOs. And with 6 weeks ago, the DSOs just went crazy. Basically, either customers were not paying, or if it was a subscription service that they didn't want to cancel, they were immediately getting on the phone and asking to be given some amount of time free or at least more favorable payment terms. So there are a lot of business metrics that each of our companies is tracking and reporting to us and that we're aggregating. Those are the typical ones. Churn is critical. Renewals is another one, right? Somebody who has to make a decision, even though it's an existing customer, that they're going to extend and renew their contract with you. And of course, new business, which went to zero, and we're waiting to see, or almost to zero, waiting to see when it picks up in various companies. But this DSOs, days outstanding, sort of how our company's customers are paying, I think is going to be a critical one that will show us. When it starts to shrink again, then we'll know that at least that universe is feeling more confident about what's going on. But I want to maybe switch sectors if you want. And the area, we didn't talk about it a lot, but the healthcare area has been hit very badly by all of this. And the things that we'll be looking on the healthcare side to begin to see a recovery, at least in that sector, are twofold. As we all know, hospitals basically have shifted all their capacity to COVID right now, okay? So when we start to see, or shutting down because they're not essential and so on. So the capacity that's available in hospitals for everything other than COVID has shrunk almost to zero and will gradually grow back out as area after area comes out of this very, very tight spot that we're all in right now. So we have reached out through industry associations and so on to the hospitals to continue to track sort of where they are with that. So far, to be frank, we haven't seen any change yet, but we expect that that will be a good indicator. The second one is medtech, medical devices. If you think about it, and again, I won't go into a long dissertation here, but a lot of what medtech addresses is discretionary cash pay type stuff that indicates that, it's not mandatory. It's not somebody who needs an immediate treatment. A lot of it are things like, obesity, hair restoration, knee replacement, hip replacement, all those kind of things. That's almost gone to zero. So again, another thing that we're tracking is to see when we begin to see some activity in there. And again, there are groups that are forming around to be able to report at least what's going on in those areas. So on the healthcare side, it's a little bit different than just revenues and churn and so on. It's more about sort of it went to a complete standstill and when will it start to free up.
Wow, this is very, very insightful. So we're about 2 minutes beyond 4 West Coast time. Let's kind of, that brings us to the end of the main session, and we'll now move to the Q&A session. So Najib, I'll turn it to you now to guide the panel through questions from the audience, if you don't mind.
Okay, thanks, George. We have a few questions that are listed in the Q&A section, but maybe the first one is really administrative. That's for you. If someone is interested to contact the panelists here and because they're interested in fundraising, what's the best way to do that?
Does anybody want to take a shot at it?
They can reach out to us directly or through you, George. Either way.
Yes, no, absolutely. We can do it through LebNet.
Okay, all right. We'll go on the questions now. Will investors become more interested in social impact startups after COVID-19? Maybe Habib Haddad or Jeff could take this question.
I mean, they're getting interested right now. I mean, we see some of our companies that have been having opportunities to start these side projects, like the company I mentioned that's doing the rapid testing of COVID is getting today funded by large philanthropists to pursue this program. I think it's going to be a bit tricky to figure out how to merge that with the core mission and the venture side of the business as well. But we'll definitely see more of that. And I can tell you also from a science perspective, we're a fund that is affiliated with MIT. We see a lot of scientists the revenge of the scientists, if you want. People are coming back and saying, so there's been a particular scientist actually at the Media Lab who's been talking about the pandemic since I want to say December or early January, as soon as the numbers started hitting in China, where he started saying that we're gonna, in a few months, we're gonna be all at home. We won't have to worry about budgets anymore because they talk about a budget faculty meeting, and all of this will be irrelevant. And everyone was laughing him out at that time. This is too extreme. We're so far from that. And what you're saying today is obviously science becoming much more relevant. And to back to your question on the social impact, you see a lot of that work actually happen on the academic side. So I think there'll be much more focus and much more a movement for philanthropists to double down on that and try to do a real change through academics and through science to start with, and ultimately it's going to also end up into this venture world as well.
Thanks, Jeff. You wanna?
Yeah, so there has been a sort of a spike in interest in social impact startups, and this has become especially the case given that they have seen that in some of the cases, it can end up in a venture scale outcome. So like investors who weren't used to investing in these type of companies are now more and more interested. We've recently invested in a company that is sort of developing a biodegradable packaging solution. And the challenge there is there's definitely interest, but at the end of the day, especially when you're dealing with like venture capital investors, you want to see sort of the way how you can leverage sustainability, but at the end of the day, get to an outcome where it's big enough to justify like the investment.
Okay. Maybe a question here to Habib Kairouz. The government reaction around the world has been fairly robust in support of small businesses and startups. Would you foresee the same reaction if there is a second wave of the virus?
You mean by governments and stimulus programs?
Yeah, I guess so.
Yeah, I would think so.
Abdo, anything?
Well, let's understand exactly what the government, what the Fed is doing, at least in the United States and the European Bank are doing. It's actually not stimulus. What they're doing, they're covering they're covering people who have lost their jobs, and they're covering the businesses that are struggling today. That's not a stimulus. That's really a backup. And this is the first time where the Fed actually, which is very different from the 2008 crisis. The Fed is actually giving loans to small businesses, and be it through the Small Business Administration or whatever mechanism through regular banks. So the Fed is getting into the loan origination and the loan management process, which they're not equipped at doing it. And right now we have, we have what, 100% of our GDP, our debt is close to 100% of our GDP in the United States. It's not as high as Japan, but it's quite significant. Would they continue putting money? Yes, I think they will, because they have no other choice. I think politically it's not going to work, but the consequences are going to be very significant. The first consequence, I can assure you that the taxes on all of us are going to increase very soon, irrespective of who's going to be the next president of the United States. Somehow, somewhere, we have to go as a society and pay this money back, because we have consumed that money. And the second piece that's going to be quite important is look at history. We're living in a period similar to the period after World War II in terms of fiscal and financial situations. That period went very well, so there's no reason that period can go well. But we have to look at different mechanisms, both on the fiscal level and the monetary level, and that's going to take a while to figure out.
So maybe as a follow-on question, the government has offered small business loans through the PPP program, Protect Your Paycheck. And initially, I think there has been a rush to apply and get the cash because the qualification seems fairly low. And then in the second wave of the program, there has been some tightening due to some excesses of organizations like Lakers and Harvard and Stanford applying for those loans. What are you recommending to your startups? Maybe Habib Kairouz or Khaled, take this question.
We're recommending to our CEOs to only look at this vehicle of funding if it's absolutely necessary, and if it's being done within the context of the guideline and the purpose that these PPP loans have been set up to do. So companies where survival is of an issue without it should certainly tap into those or apply to tap into those loans, because that's exactly what those were set up to do. But companies that have access to alternative sources of capital, or that have enough to weather the storm, should look elsewhere. These programs are being set up to help companies that are in dire conditions because of this environment.
Khaled, you want to take on?
I agree 100%. By the way, we all went through whiplash with this thing, going from it's available to everybody, just grab it as fast as you can, to oops, maybe not, to let's think about it, let's talk to lawyers, let's talk to the MVCA, etc., to now all the way back to if absolutely necessary and no other sources. And you can show a million things, and you documented not just today, but going back to when the whole process started and discussions and board discussions and so on, then a very small number will. I will divulge some information here. Portfolio 60 companies, at one point, 2 Mondays ago, we had 12 that had either prepared or submitted applications. Today, there's only 3 left that have submitted applications. Everybody else either never submitted it, even though they thought they had a case, or pulled back on it. I think what you have to take into consideration is this is going to come under humongous scrutiny, right? And even if you meet even the letter of the needs, the requirement, there's going to be various bodies and Congress and the press and so on coming after you. And how's it going to look is another question. You may not like that. So unless it's absolutely necessary and you completely cleanly fit into the criteria of the companies that need this money, if you are venture backed, especially most of our companies are older because we haven't been investing in IT recently. They have a big board. They have a lot of investors around the table. They have sustainable businesses. It's very hard to justify and feel confident that it's not going to come back to bite you. So our pendulum went to have at it all the way back to a couple of companies out of 60 will actually get that money. And it's small amounts, by the way. That's the other thing.
Okay. Thanks, Khaled. Another question is about stress tests. I mean, have you developed stress tests for your portfolio companies? and future investments as a result of the lessons learned from COVID-19. It's like what happened to the banking industry in 2009. There were some stress tests. Are you putting those in place? And can you share the top 2 or 3 elements of such plans and tests? Anyone wants to take this question? Abdu, maybe.
Yeah, Najib, happy to do it. That is, we do. We have done it with every one of our companies, and we do it based on scenarios, as I mentioned before. And we took 3 scenarios, you know, a worst case, a best case, and more of an expected case. And for each one of these, we developed the implications from a profit and loss perspective, as well as from a balance sheet perspective. And the key, the art here, the science is you can basically build the models very easily, but the art is estimate or predict these scenarios and make sure that you don't miss them. And that's what we've done. That is, we've been across the board doing it. And, you know, and if we feel like these companies might need cash, we have cash available for them. And if they don't, we basically leave them alone. But that has been imperative for us.
Okay, thank you. Another one on the appetites of investing in startups in this current environment. What is the VC appetite when it comes to adding new investments to the portfolio? Is there a waiting window right now, maybe waiting for better valuations? And when things recover, would that focus more on early stage companies or later stage companies? Anyone wants to take on this question? Maybe Habib Kairouz or Habib Haddad?
I mean, I would, in terms of valuations, we certainly expect to get different types of valuations today than we did 3 months ago. Because even if a company is doing exactly the same way, there are many places for us to invest, and we prefer to invest in companies where valuations are being taken into account for what happened. In terms of the appetite to invest, I would say it really depends on the stage and the type of company. If a company is addressing the current environment and has a market currently receptive to its offering, for sure. If a company is going into product development for the next 2 years and not facing the market for customers, for sure. If the company is coming out of a Series A stage, is starting to sell the product, and the product is not a must-have in today's world, I would say investors are going to be worried, because what you're doing, even if you're investing in a solid company, you're picking up a burn rate and potentially a situation that's running on a treadmill while burning capital until the market opens up, and none of us know when the market is really going to open up. And that's where I was talking about investor syndrome of a bunch of people, the market basically being all worried at the same time. It's just that who wants to deal with another headache and another set of adjustments of cost structures when you're looking to sell and generate revenues to cover your cost structure? If all you're doing is product design for the next 2 years, then yeah, by all means, this is a great time to do it.
Okay, Habib Haddad.
I think yeah, just to add some things to what Habib mentioned. On the seed stage, your mileage may vary. So you'll see some seed funds, some seed funds are still very active, but the majority are focusing on their current portfolio. So the majority are just thinking about how to extend runway for existing companies. But with that said, I mean, we have 2 or 3 companies. One company just this week got 2 term sheets from Tier A investors on the A, and they're getting really good valuations as well. But this is a company that's actually seeing a really good bump up in the current environment. And then the other thing that we're also seeing, we're also sharing with our companies is you're seeing the second thing you're seeing, by the way, is just insider rounds. So a lot of funds just coming in and stepping in and just paying up. And you're seeing also the comeback of pay to play. Just this is a term that hasn't been really around for in term sheets for a long time, at least in seed stage, was coming back to penalize investors who are deciding to just take a ride and not coming in and not participate in these rounds. But also the companies who are now benefiting from the current lockdown, they're also trying to be very creative. It's very hard to get a new investor to invest in you. Many people are saying that they do writing new term sheets without meeting founders, but still hard. So what we're advising founders is to figure out ways to make sure that you find any excuse you have to have a video call with a potential investor, just for them to kind of break down that familiarity and having that connection. And the other thing is just to be creative. We have one of our companies who build these really massive drones that fly over agriculture fields. And what they've been doing for the customers and for potential investors down the line is they put cameras on every single on the drone and on the boom, etc. And they're doing these amazing live feeds of the drone flying, something that they wouldn't have thought about pre-COVID, because you can just get the potential customer to see it there. So people are also getting creative around that. I think the near term, though, you'll see much more insider rounds, and then from a macro perspective, seed stage, I think they've raised $8 billion, $8.5 billion last year. That's not gonna, go down significantly. We've seen so many seed stage funds emerge in the past few years. I think maybe there's like 150 or 200 funds each year. You'll probably see some consolidation there. Some people might drop. The nano funds, the $10, $20 million funds might not survive. So you will see some activity happening there on the fund side, but on the good companies will always find good investments. Those who are going to be hurt and are focused on pure innovation and pure nice to have will probably be the first one to significantly get damaged.
Okay, thanks, Habib. Another question, do you see new opportunities arising during the COVID? Are they strategic with long-term revenue potential, or they are opportunistic for physical distancing and others? I know that Habib Kairouz, you touched a little bit on that, but are there specific opportunities that look strategic because of COVID-19? Habib or Khaled?
Yeah. What I alluded to earlier is that now that the world has recognized that these kinds of conferences, working from home, are things that are a much more integral part of the day-to-day operations. Think of the IT infrastructure has typically been very much controlled for the office work and potentially remote work while using office devices. Now, if you're working from home and it's a much bigger percentage of the organization, the IT organization of your employer has to look at the overall architecture of their organization in a much different way. Security is much more important for mobile apps, for example. So there will be a lot of investment opportunities around distance learning, around telemedicine. These areas are here to stay and are long-term secular opportunities that will create a lot of tangential opportunities around them to take advantage of those waves.
Khaled, anything you want to add?
No, not really. I mean, I think there may be whole new areas that emerge months down the road and a year down the road if this continues and sort of the world settles back down. And as I said earlier, we're not doing IT investing, so I'm not seeing as many opportunities as anybody else on this panel, but it could happen down the road. I don't think it's happened yet. We're still all dealing with the immediate after effects of the crisis and adjusting to these new realities, what Habib just went over. But typically when there is a shaking up of something, of this economy or of the way we live, new opportunities that are much more strategic and longer term will emerge. I just can't name any right now.
Okay. Have you found yourself? Okay. Sorry.
And I was just gonna add a quick one to that we're seeing an area, I'm sure many will agree, as well as on distributed manufacturing and on just digitization of the factories. This is just an area that production has to continue, and you have a few companies who've been working in the space of helping factories move from the physical to the digital on not just on automation, but also on quantifying, on measuring every step of the process. And these companies are seeing the secondary effect of COVID, of needing to to still continue and still operate within these environments. And these are behaviors that are going to stick. So they're not going to be just temporary behaviors. And probably that's going to be one area that we'll look more into, anything around logistics, supply chain, anything from sourcing on the risk of the supply chain, which every single food and beverage company or CPG company is now facing, from to the actual warehousing and automation there, and the last mile delivery as well. That's an area that we think is going to be quite, the behavior is going to be there to stick.
Maybe meat packing. Because of what's going on now, maybe that will be more automated, and robots will be used more and more.
Distributed meat packing, you're going to have your cow in the backyard and your goat in the backyard and your chicken.
That's right.
Maybe one question for everyone who can answer it. Have new investments completely dried up, or are VCs still open to making selective investments? Abdo just signed a deal today, so probably he answered that question. Maybe for the others?
We're still investing. We're still open for business.
Yeah, I think the message was that they're still investing, but maybe the valuations are not going to be the same. At least that's what I heard, but I could go.
Yeah, we're definitely investing. We closed the deal 2 weeks ago, and right now we're in the negotiation phase, and we're probably gonna close another investment in the next few weeks. So we're definitely continuously investing. And if you look at, like, historically, a lot of great companies were built in downturns, so it doesn't really justify like stopping like the whole investment process. But of course, it really depends on the industries. If you're, we probably won't invest in a company that's directly affected by what's happening, but definitely we're open to making new investments in the coming year.
Okay.
Should we take a last question, Najib?
A few, maybe we'll take another 5 minutes. Could we do that?
Yeah, sure. 5 minutes would be good. Okay.
Okay. Have you found yourself recommending to the portfolio companies different branding, let's say focus on social responsibilities, internal inclusion, supplier diversity? Are those some of the things that might mitigate the risk for startups? Anyone would take that question?
No.
I think social investing and social responsibility started way before COVID and is a trend that's here to stay. I don't think it's helping us deal with the COVID situation though.
Okay, I have a question here from Beirut. I'm going to read it. I believe most people are asking the context part of Lebanon is very unfavorable, especially due to the financial crisis and COVID. Yet we have a sectarian and clientelist crisis that's hindering the modernization of the country and depending overly on a rentier economy. Do you believe that the country can emerge as a productive one, given the potential of the oil and hopefully more subsidies offered to startups? Or is it because of the drastic political and sectarian situation, startups would not be able to thrive in a country like Lebanon? Maybe
you should answer that one, George.
About that.
Well, I can take a shot, but let me see if anybody else wants to take first shot at it. Okay, I'll go.
Go for it, George.
Listen, I mean, obviously things are so dire right now that discussing how we could do that is a challenge. But I think I did hear at the beginning of this session the fact, and I think it was Khaled who mentioned that right now the hubs are going to probably be less biased. There's going to be a lot of good value in groups that are spread out, and I think this could bring an opportunity to startups in Lebanon to be able to compete remotely and have employees in Lebanon working. Having said that, obviously this is something we've been working on a lot at LebNet and other organizations, which is creating those jobs and encouraging our diaspora group, the LebNet members in North America, about taking a chance on employees in Lebanon, in the tech industry, for instance, biotech or whatever, and encouraging those startups to continue to hire locally and to thrive. So we've been doing that for a while, in a sense that we're encouraging startups to come here to Silicon Valley for a couple of weeks or 5 weeks, get exposed to what would take to do business here. We encourage them to register in the United States, to be a Delaware company sometimes, do their business development here. We try as much as possible to help them. That's not going to change. But, with COVID and everything, obviously that's been delayed. And whatever we're discussing here on this call is probably more immediate for a North America / European market. Probably Lebanon will be lagging a bit behind that. But that's all we do here in LebNet, trying to keep an eye on how to create opportunities, continue to create opportunities for startups in Lebanon.
Okay, thanks, George. 2 more questions and we're done. What advice do you have for first-time managers raising capital in this environment and building relationships with LPs? Maybe Khaled and Abdo and Habib.
Can you repeat it? Is it raising
what advice
LPs at the end?
Yeah, what advice do you have for first-time managers raising capital in this environment and building relationships with limited partners?
Okay, I'm going to assume that they mean with VCs, with the GPs, with investors. I mean, I think it's a lot of it we've covered. I mean, you have to be a lot more patient today than you were before. The business plan that you're going to go to talk to people has to be either relevant in the current context or something where you can show that at a certain point in time, it's going to be relevant for that context over there. I think low burns at this point, and a lot of very early companies have low burns because they're still in the development, the R&D development stage, will be critical. Because again, in a time of uncertainty, people don't want to be putting in money and seeing it evaporate over a short period of time. I think a 2-year horizon, I think Habib mentioned that earlier, is sort of what you need to be thinking about, even though traditionally that was not the case. A lot of seed rounds, a lot of very early stage rounds were done, a year, 9 months, because there was always money available to continue to pick it up. I think now if you're starting from scratch and you're able to interest somebody, you've got to be thinking, you've got to convince your investor to be thinking in terms of 18 to 24 months, because the uncertainty is there and you don't know if this money that's been sloshing around is going to be available when you need it. So capital intensity is important. Cash runways will be important. Relevance to either the current situation or if you're in the development stage, so where you can show sort of how you'd fit in a post, I hate to use that word from the beginning, but post-COVID word, all of those are things I would do, but use this time to develop the relationship. Somebody joked, and I know it's not true, but somebody joked that the VCs have nothing better to do right now than to talk to people. So there's your opportunity.
Okay, maybe we can conclude with this question, and maybe each one of the panelists can quickly give their answer. Who do you look up for inspiration to shape your view of the future or to cope with this reality that we're all in? Abdo, do you want to start, and maybe we'll...
Okay, I won't make a political statement. I can tell you there's someone I cannot even stand hearing. But really, the person that really I look for is Bill Gates. I've been, I subscribe to his blogs, and he literally today had a great blog on vaccines. And this is the kind of person I look for inspiration.
Habib Haddad?
I look for a number of people. I think I've long gone past the idea of one person being a person to look up for. I think there's in the first series episode of Orange is the New Black, there was a really nice statement that caught my attention, which was everyone is better in the abstract. That probably includes also Bill Gates. And so I think it's good to think about it from multiple people. And in particular, I've been now much more attuned to looking at scientists. So people that might be known or not very well known, but it's a lot of scientific journals, a lot of podcasts around that. and things where people have been knocking and been telling us that this is going to happen. Bill Gates have been saying it and repeating some of the word that scientists have been telling him. But I think science is a place where I would look a lot. I'm looking a lot for.
Thanks, Habib. Khaled?
I don't have a good answer for you on this one, so I'll pass.
Okay, Habib Kairouz?
Khaled might be setting a trend here, but I'll just to pick an answer, I'll go with Zuckerberg, who was able to build an incredible company at a very tough time in the market when no one was paying attention to these social networks anymore. And he saw a real opportunity to go in and create a mammoth company. So this is to maybe end on a positive note that despite everything we're hearing around us, there are still opportunities if people are real believers in their projects and really passionate about their ideas. And there will be opportunities to build very interesting stories in environments like this.
Thanks, Habib. Jeff?
It's probably Ben Horowitz, given especially the resiliency that he's had in the past. He built his company, went through went public, performed horribly on the public markets initially, but kept going and went through different financial crises, and at the end was able to sell his business for billions. So I feel like, especially right now in these times, resiliency is super important to have.
Okay, thanks. That's it for the Q&A.
Excellent. Thank you again for attending this session, everyone, and special thanks to our panelists. If you missed parts of this webinar, we're going to be posting the recording in about 48 hours. And please stay tuned to other webinar announcements coming soon. We actually have about 4 in line in queue, and we'll announce them soon. So stay healthy and be safe. Thank you, everyone.